Awesome. I think we are now live on our various social media channels. My name is Andrew Wall. I'm the managing partner here at CPA 4IT. And today's session is how to avoid mistakes while filing your corporate tax return. I do have a slideshow for today's session, so let me pop that up and share that screen with you. So let me share my screen here. Perfect. And I'm going to drag this up and out of the way. So I can still see the Q&A up in the top left, but I can go through our session with you guys down below. So as I said, my name is Andrew Wall. I'm the managing partner here at CPA 4IT. And today's session is how to avoid mistakes while filing your corporate tax return. Now, we'll start with a little bit of housekeeping. As I said earlier, for those of you who are here with us live on Zoom, you can post your questions into the Q&A, and I will do my best to keep an eye on those and answer those questions as we go throughout the session. If you are joining us on any of the various social media channels, please feel free to post your comments below, and we will have one of my colleagues relay those questions over to us live in the session. And of course, if we don't get a chance to answer those live in the session, we will come back and answer those comments on the various social media channels. As I said, my name is Andrew, and I'm the managing partner at CPA 4IT. And our mission here at CPA 4IT is to help entrepreneurs organize their finances, create wealth, and transform wealth into a legacy. And I would say today's session sort of blends somewhere between organizing your finances and creating wealth, because if you make mistakes on filing your corporate tax return, you're going to definitely decrease your wealth because there's a lot of penalties associated with that. So let's talk about some of the importance of doing an accurate corporate tax return. It's going to help us avoid CRA audits and CRA penalties. It's going to maximize our savings because when we're proactive as opposed to reactive, we can do more tax planning and strategies, and it avoids the interest on any unpaid taxes or installments. So some of the common mistakes that we see in preparing a corporate tax return is first and foremost, not reporting all earnings. So this is a obviously very critical one. It doesn't happen all that often in IT consultants, but if you are earning revenue or you have income coming in any way, shape, or form, it goes without saying that that income needs to be recorded as income. And when we do see issues, it's usually on reselling of products and services and stuff like that. And they're just like, oh, it's just a reimbursement. I won't record it. And what we always tell our clients when it comes to reimbursed expenses is that you should report the revenue and report the cost so that there's no net tax for you, right? Because you have the revenue of, let's call it $1 for argument's sake, and you have the cost of $1. So there's no net income. So revenue minus expenses is net income. So there wouldn't be any net tax implications, but you've reported the income so that you don't run the risk of CRA coming back down the road and saying, hey, we can see these deposits into your account. Why haven't you reported this as income? Well, it's because it's a reimbursed expense. Well, why didn't you report the expense? And maybe they add the revenue and deny the expense, or they've reassessed you after 3 years, and now they'll allow you to claim the expenses and the revenue, but they won't allow you to claim the input tax credits for the GST on those expenses. So obviously things like your contract income, interest income, investment income, rental income, reimbursed expense income, all income needs to be reported. And this is a critical one because CRA will bring the hammer down on you if they feel like you are not reporting any of your income. Obviously, the other big expense related to this is just not keeping track of revenue expenses on a regular basis. So it's obviously imperative to ensure that you have some form of ledger so that you can prepare the tax return, which would include your revenue and your expenses. But I would say the mistake we see most people do is that they'll deal with the revenue and expenses on an end of year basis, and if they get to it by the end of the year. But when you do that, as opposed to doing your bookkeeping on a monthly basis, what often happens is you get to the end of the year, you're busy with regular work, you're busy with life, something else comes up, and then it gets delayed. and then you're filing late, and then you're paying interest, and then you're paying penalties. And what we see time and time again is people who get many, many years behind, and then they start to bury their head in the sand. And it really stems all back to this original issue of not keeping track of your revenue expenses on a regular and ongoing basis. Now, we do provide a free cred manual that you can certainly keep up to date on a monthly basis. But there are also lots of cloud accounting tools like QuickBooks Online and Xero. And if you didn't even want to use one of those, you could even use Dext in sort of like a hybrid cred model, or one of the other receipt management tools. So Dext isn't a general ledger tool or a bookkeeping tool. It is a receipt management and capture tool. But I'd rather see you doing that on a monthly basis, rather than, not doing anything. And of course, what we do love about Dext is that we've got the original receipts in there. When you're using QBO or Xero, you may or may not be including the original receipts with the transactions. But we do tell people that keeping your receipts and bookkeeping records is imperative, because if you get to the end of the year, you file your tax returns and you've got everything's on time and great, but then you get either an audit or a reassessment, and you need that receipt information to go back to provide to CRA, to challenge a reassessment or to provide in the event of an audit. Gathering and collecting those can be difficult if you're not using an organized system. And that organized system can be physical, old school, like, a file folder with the individual receipts, either by vendor or by month, in a way that you can locate them quickly and easily, or by leveraging some of the tools like Dext, that will allow you to just snap a picture on your phone of that receipt. It can then OCR it, which then makes it searchable by amount, by date, by vendor, a whole bunch of easy information that can make those audit and those reassessments a breeze compared to having to go back and find them and locate them. And what's important to be aware is that, well, we as your accountants will certainly take, a general ledger or a set of books that have been prepared without the original receipts because we don't need them. But if you do go through that audit and you don't have those sort of supporting documentation, that those expenses will be denied by CRA without the supporting document, because your credit cards and your bank statements are not considered valid source document from a CRA perspective, because they don't contain line item detail. They don't have things like the HST account numbers and stuff like that that are required to be on an original receipt. So the receipts, they do not have to be physical when going through an audit or a reassessment. You can keep them in digital format as long as they're legible and reproducible. So one of the things we do know when it comes to thermal paper, which most receipts are printed on, is that they will fade over time, particularly if you leave them out and somewhere exposed to sun or heat. They will fade extremely quickly and become illegible. So if you go to produce a receipt and it's no longer legible, you cannot produce that receipt, which is why we do strongly encouraging taking pictures with your phone, even if you don't use a product like Dext or any of those other tools. So another key mistake is just not keeping track of those records. Another common mistake we see is not registering for sales tax. So once you make more than $30,000 of income, you are required to register for sales tax, GST, HST. But what a lot of people don't realize is that you can register even if you're below $30,000, and that with GST, HST, it can actually become a profit center. And what I mean by that is if you're using the quick method of HST, and you collect 13% from your individual clients, you actually only have to pay the government 7.8% of the first 30,000 and 8.8 of everything above that. That means you've collected 13 and you only have to remit on the up to first 30,000, 7.8, which means you get to keep the delta of, 5.2%. So it becomes a potential profit center for you. Now, if you're on the long method of GST, HST, it's not really a profit center, but it also doesn't cost you anything, which is why we strongly encourage people to register for the GST, HST quick method, as soon as they can. And related to this is setting up GST, HST using the wrong method. So when it comes to GST, HST, there are two methods for reporting your sales tax. There's the regular method and there is the short or quick method. The regular or long method is you take what you collect, you subtract what you've paid on your individual expenses, you owe the balance to the government. So even in the long method, you're not paying back to the government the full 13% that you've collected. You're paying back the 13% less what you paid on the GST, HST, which again implies that you are making something a little bit with the long method. That quick method, as I said, it's only 7.8 of the first 30,000, 8.8 of everything above that. And then instead of separating out the input tax credit from your expense and reducing your GST that you pay, you include the GST as part of the expense, so you get a larger expense deduction. And then again, the difference that between what you've collected and what you pay the government becomes income to you in what is called sundry income. So it's important to know and understand which method is actually best for you, the long method or the quick method, and choose the appropriate method. So for example, if I'm an independent contractor here in Ontario, my client is in Ontario, I'm a service-based business, I don't have, any true cost of goods sold other than my labor, the quick method is definitely going to be the better method for me. Now, let's say I'm here in Ontario, but I'm in manufacturing or retail where I have high cost of goods sold and I'm paying HST on those cost of goods sold, then I actually might be better off using the long method. Now, in another situation, let's say I have a US end client who I'm not charging GST, HST, and I'm paying GST, HST on my various supplies that I use in my business. In that situation, the long method is actually going to be better than the quick method. Even though I said if you had a Canadian client, it would be better in the quick method, even if you had the exact same expenses. And that's because in the long method, if you have collected zero and you've spent, even if it's $10, zero minus $10 becomes a refund. Now, in the quick method, zero times 7.8% is zero. So you pay zero, but you don't get a refund. So there would be no refund in the quick method, whereas in the long method, there would be a refund. So knowing which method and making sure you're registered for sales tax is really another common mistake that we see. A not so common mistake that we see, but it does happen periodically, is not having a separate business bank account number. We have seen very rare situations where people have just taken the invoiced the client and then taken the check and deposited it into a personal bank account. The problem with that is that can be deemed to be personal income, not corporate income. Because if you receive a check to a corporation, it can only be deposited into the corporation's bank account. So it's really important to make sure that you have a separate business bank account. And I would go one step further. I'm not sure if we've got that in this next slide. I apologize. This is relatively new content for me. But I would say not having a business credit card as well. Now, it is acceptable to have a personal credit card that is used exclusively for business, and we will certainly allow that and kind of treat it like it's a corporate credit card. But the issue you have with that is one thing that we're going to have to do is at the end of each year, we're going to have to remove or clear the closing balance against your director's advances. So if you owe your credit card, that's going to be cleared against your director's advances. Or if you have a credit balance on your credit card, again, it's going to go against your director's advances. Because if it's not a corporate credit card, it doesn't sit as an asset or a liability on your balance sheet. So it has to be removed and that balance has to be cleared somewhere and it's cleared against your director's advances. In addition, if you have a personal credit card that you are using for business reasons, then any costs associated with that credit card, if it's a free credit card, I guess it's mute. But if it's one of these fancy Amex credit cards that gives you all the points and travel benefits, then the cost of that credit card, CRA could deny that as a business expense because it's not a business credit card. So going along with not having a separate business bank account is not having a separate business credit card. And I would say that this is really important for making sure that we can deduct any costs associated with that credit card, as well as not have any additional burden to the director's advances. at the end of the year as a result of having to remove those balances that we've tracked all throughout the year and clearing them against your director's advances. Another key mistake is not leveraging all of the available deductions for you. And up on screen here, we have a list of some of the common deductions. This is not an exhaustive list. What this is intended to be, and all of our chart of accounts is intended to help guide you on the types of things that you could expense. But when it comes to deducting eligible business deductions, there are three main criteria. First, it has to be, it can't be specifically disallowed by the Income Tax Act. And the good news is there's not many things that are, but there are things that are specifically disallowed, like golf green fees, club memberships, life insurance, your primary home telephone line. Those are specifically disallowed by the Income Tax Act. But outside of that, they have to meet two other criteria. So those other two criteria are that it has to be reasonable, which is subjective, and it has to have the ability to help your business earn income, which again is subjective. So effectively, if you've got an argument for why it's a deductible business expense, like if you're claiming dog food and you have a puppy, you probably can't claim that. But if you are a dog breeder, and you could certainly claim that. So there's different expenses that could be reasonable under one business that are completely unreasonable under another. And that interpretation is very subjective. So what we're looking for is an argument for why it would be reasonable to have spent this money and why it would help your business earn income sometime in the future. CRA might disagree with that. And what's interesting to be aware of is that within CRA, you're going to have three levels of appeals, but it's not actually up to CRA. And in fact, even if CRA disagrees with you at all three levels of appeals, you have the right to take it to tax court and go through three additional levels of appeal through the court system. And it's ultimately up to the courts to decide whether expenses are deductible or whether you have done anything within your books that is not reasonable. It's not up to CRA. And most people believe it's actually CRA's decision when it actually falls in the jurisdiction of the courts, not CRA. But the reality is most people aren't going to challenge, let's say, a business suit that I might have claimed under advertising expense that CRA is now denying because they say, anything that you wear in public or you could wear in public is not a deductible business expense. And specifically with this business clothing issue, this is the real issue that we've seen. CRA will deny business clothing for anything that could be worn in public. We disagree with that. We allow our clients to deduct this, but the problem is if CRA denies it, most people aren't going to go to tax court over a $2,000 suit, right? So you'd have to have a meaningful amount to justify the legal fees to go after it. And this is how CRA maintains their pressure, is they know which fights they're going to win and which fights you won't even take to the courts and which fights that if you are going to take to the courts, they're not even going to challenge. And we have seen many consented judgments because they know they're going to lose the case, so they don't even fight it, and they don't want the jurisprudence in there that can be used against them in the future. And then in situations like this, they'll blanket deny business clothing because they know most people aren't going to challenge them. So that's another common mistake that we see available. This is a big one, not keeping an automobile log. I say this to everyone over and over and over again because automobile expenses are one of the most scrutinized expenses. Again, this is CRA not really playing fair. They have learned that most people do not keep a mileage log. And so it is the most often audited account that they are going to want to look at because they know most of you haven't kept a mileage log and they're just going to deny the expense because this is required. To be able to deduct automobile expenses is you need to have an auto mileage log with where you've driven and the purposes of what you drove and the business reason as to why you drove there. The good news is that there are now tools available to make this really easy for you to do. Within QuickBooks Online, there's a free mileage tracker if you're paying for the software. There's also other softwares like MileIQ outside of QBO that can allow you to keep track of this. Of course, you could just keep this in a diary or a logbook or an Excel file or whatever you want. But what we find time and time again is that we get to the end of the year, we file the returns, it gets audited for whatever reason. They ask for the mileage log. The client then could certainly go back and recreate that mileage log for their calendar, but they look at the auto expense of maybe $5,000 or $10,000 and the tax that they're now going to have to pay on that, which is 12.2% of that. And CRA denies it, and they can't be bothered to go back and recreate the log, so they let it go. Problem with that, and you're certainly well within your rights to do that, and CRA then just denies the expense and you pay the tax and the interest. But the problem with that is now CRA has figured out, oh, this is what happens 9 times out of 10. So I'm going to challenge this with everybody. So it really is important to keep that mileage log. So claiming personal expenses, things that are, things like trying to claim diapers or daycare, stuff like that. We do see that obviously increases your audit risk with CRA. It can lead to reassessments and penalties and all the fun things that go along with that. But what it can typically result in is a deeper dive into your file. So let's say that you're audited for general reason, like, it hasn't been flagged because of a benchmark or anything like that, but you're just audited for a general reason. And they come across expenses that are suspect. Typically in that situation, they are going to dig a lot deeper. And so what I always tell people is the expression we use around here is pigs get fat, but hogs get slaughtered. So if you know that that there is no reasonable business reason for this, and it has no ability to help your business earn income, don't get greedy. You can't claim diapers. You can't claim medical expenses unless you have an insurance policy through the corporation. You can't self-insure on medical expenses. You can then claim those on your personal return, no problem. But don't be greedy because it will come back to haunt you. Now, this is one we see over and over and over again, is not paying your corporate tax or GST, HST installments. And what will happen in that situation is if you get to the end of the year and you haven't paid your installments, CRA will charge you interest from those installment dates. So, why give CRA? I hate giving CRA any money more than I don't want to give them anything more than what they're entitled to. And our goal is to keep what they're entitled to as low as possible. I'm never going to advocate anyone to cheat CRA or do anything illegal or fraudulent. But we do want to be as aggressive as we can and maximize those deductions when and where we can. But once you've figured out how much you owe, if you do owe more than $3,000 in virtually any tax, CRA is going to want to see installments on a go-forward basis after that first year. So if your first year, you don't have any installments in that very first year of operations, but after that first year, if you owe more than $3,000 in corporate taxes, you're going to have to pay installments towards next year. Same with GST. If you owe more than $3,000 in GST, HST, they're going to want you to go on installments on that. The installment frequency is sort of dependent on the amounts you pay, and it can get a little bit more complicated, but I strongly encourage people to pay those installments. The only exception to that is if you know for a fact that your revenue has decreased or is non-existent, then you are certainly free to not make those installments. However, if you don't make the installments, and let's say you've got no revenue for the first 6 months, and then you start working again the last 6 months or maybe even the last 3 months, you need to start paying the installments. Or what I even say to people is probably what's best is just remit in form of GST, HST, 100% of the GST you collected for those 3 or 6 months, and then you'll get a refund. But if you don't make those installments, maybe you owe less than what the original installment amounts were, but they're going to charge you interest on what the actual amount is you end up owing. So make sure that you review the client checklist that we provide for you, which includes all the installment amounts that you're going to need to make throughout the year. And sometimes people get confused because they'll see an amount that they owe for the current year, and they see installments that total to a similar amount. So they think, oh, it's one or the other. No, it's not one or the other. It's you're paying tax for the current year plus the installments towards next year. So it's typically both. So don't get confused by that. Another common question, another problem, common mistake we see is not saving enough money to pay their taxes at the end of the year. And what I typically advise clients when they ask is to set aside 30 cents for every dollar that you earn. If you set aside 30 cents on every dollar that you earn, you will have more than enough for the GST, HST, corporate tax, payroll tax, and probably even have a little bit left over. Now, of course, that does vary. There are situations where you might be above 30%. But for the average IT consultant, typically 30% is enough to set aside to cover all your payroll taxes, corporate taxes, GST, HST, and still probably have enough left over for at least a dinner out, if not something a little bit more substantial. But we have seen it time and time again that people end up getting to the end of the year. They either avoid preparing and filing their taxes because they know they don't have the money to pay it, and so that creates anxiety, and then they just try to, take the ostrich approach and bury their head in the sand. If they don't do that and they're at least filing their taxes, they could still incur penalties, interest, not to mention all the stress that can come along with that. CRA is going to probably typically initiate a collections process. And if you bury your head in the sand on that, they are going to take you to court, and they could freeze your bank accounts and garnish your wages. So don't do that. And if CRA, if you're into a situation where you owe, you can't afford to pay, the first step is to get in contact with CRA's collection department and work out a payment plan with them. Almost always they'll give you, a minimum of 3 months payment plan with, generally speaking, no questions asked, sometimes even longer than that, depending upon the amount of money that you owe. But be in contact with them. You don't want this to go through the court system. You do want to handle this through their collections department if you are struggling to pay. But as I said, it can lead to penalties, interest, stress, and compromise the operations of the business itself. So don't do it. Another common issue, and this almost should be up there at number one, is improper share structure and organizational structure. And share structure is really important when it comes to income splitting, because if we ever want to do dividends out to various family members, we need to have a separate class of shares for them. Otherwise, if we only have one class of shares and those class of shares are split maybe 50-50 between a spouse, or 1/3 between 3 people, if we issue a dividend to that class of shares, that means that dividend has to be split 50-50 if it's 2 people, or a third if there's 3 people, based on the number of shares that individual owns of that class of shares. Whereas if we have different classes of shares, we can do dividends to different classes. So what we typically do when we structure a corporation is we're going to have a class of shares for every family member. And even though the new, TOSI, or tax on split income rules, have really eliminated our ability to do dividends to family members, we still create that structure as hey, we may never use it, but let's have as many options or arrows in our quiver as we possibly can. And because certainly income splitting with spouses, once you reach the age of 65, is exempt from TOSI. So we can still do dividend income splitting with spouses. And so we want to make sure that we have that share structure done properly, so that we can do that income splitting. Plus, in addition, who knows, down the road, TOSI could be repealed. And if you don't have that share structure done from the beginning, it can be complicated to change the share structure down the road. It's never impossible. Share structures can be changed, but there's deemed disposition rules. So if you change the share structure while the corporation has retained earnings, then there are deemed disposition rules that basically say those original retained earnings can only go to those original shareholders. And even though you've added a new shareholder, you can't, you can dividend out those retained earnings to them, but there'll be a deemed disposition and it'll go back to the original shareholders. So when we have retained earnings, we typically need to bring in a tax lawyer to do some asset freezes and rollovers to be able to structure it so that we can do things properly. Now, if there's no retained earnings, there are ways to change it. But again, the goal is to get this set up correctly from day one, to make sure that we've got the options available to us should we ever need them. Now, related to share structure is sort of the opco holdco structure, and knowing when and how to implement a holding company and how to structure your original operating company so that it can eventually become a holding company. Because typically, what we'll do for our clients is, we don't recommend setting up a holding company from day one because you've doubled your accounting fees for no real tax savings. So typically, our advice is let's not set up a holding company until the benefits of having a holding company can exceed the cost of having a holding company. And there are, in addition to non-financial benefits of holding companies, there are tangible financial benefits. And we do an entire webinar dedicated to our top 10 advanced tax strategies. And we talk about that in more detail. If you have questions about that, I encourage you to go and do that. But again, if you haven't structured your original operating company properly from day one with the intent that it may one day become a holding company, it might be more difficult or more expensive when it comes time to do that. Whereas for us, when it comes time to set up a holding company, it becomes very easy and very cost effective. We can do our low cost incorporations, and set up a whole new company. This new company, the shareholder of that company will be your existing operating company, which now becomes, by nature of holding shares in another company, becomes a holding company. You then cease doing your operations in that old pre-existing company. It's got all your assets and your retained earnings in there. So we're not having to worry about bringing in a tax lawyer to do rollovers and freezes and all that fun stuff, which certainly can be done. But if we can save you time and money, we want to where we can, right? So making sure that structure is done correctly is almost should be our number one mistake. We're not our number 11. But our number 12 here is late filing. So not filing a tax return on time, which obviously can lead to penalties and interest. And what we see here is consistent patterns. What we see time and time again is people are either type A, well organized, got their taxes in, 2 weeks after their fiscal year end, as soon as they get that bank statement, they're rolling it over and getting it to us. Versus the opposite end of that spectrum, what we see is people coming to us 4 or 5. We've seen some clients come to us decades after, and in very difficult financial situations when that happens, because very rarely when clients come in late, do they have enough money set aside for the taxes, let alone the interest and the penalties associated with it. And what seems to happen is that once you start to get a little bit behind, the stress and the anxiety around this forces people into that sort of ostrich approach where they ignore the letters, they just pretend they don't exist, and they just bury their head and they ignore it. And typically that gets ignored until we see the legal process initiated by CRA. And at that point, it's gotten quite costly to resolve. And as you can imagine, when we're 10 years reactive instead of proactive, there's very little we can do as far as tax strategizing and optimization. In addition, you're under much greater scrutiny for audits and reassessments because you're filing everything at once, which is a trigger to CRA. So the more that you can push yourself to do regular ongoing bookkeeping and filing your taxes on time, the lower your probability for audit, the lower your risk for interest and penalties and all the terrible things that can go along with being late. So if you're not sure of what your deadlines are, GST, HST is typically due 3 months. We have 3 months up here on the screen, but it actually is dependent on your income threshold. So for most independent contractors, it is 3 months, but I do strongly encourage you to go check your CRA site to find out what your deadline is, because it could be 1 month after your quarterly returns that you have to pay, and you might have to file every single month. Whereas if you're annual and you are below $400,000, it's not going to be due until 3 months after your fiscal year end. Assuming your HST year end is the same as your fiscal year end, which could be different, which actually maybe we need to add that into another common mistake is people taking the default GST HST structure, which is a December 31st year end, even if their corporation has a January, February, March, who knows, it could have a different year end than your GST HST, and then you're filing returns separately, which can be it's not impossible. It's just a pain in the ass and costs more in time and energy that's unnecessary. So typically GST, HST is due 3 months after, but it could be, due quarterly throughout the year, or it could even be due monthly throughout the year, depending on your income thresholds. Now corporate income tax, again, this can change. It can be up to 2 months after your year end if you are not a small business. Now, if you are a small business under $500,000, you've got 3 months after 3 months after your year end before they expect you to pay your taxes. So your taxes are due, the payment is due within 3 months after your corporate year end if you are an eligible small business. But CRA, in their wise wisdom, doesn't expect you to have the return prepared and filed until 6 months after your year end. So they expect you to know how much you owe before they expect you to actually prepare the books to know how much you owe. So this is the kind of CRA wisdom that we see time and time again. But that again is one of the common things we see over and over again is those late tax filings. And finally, not seeking professional help from an accountant who knows and understands your situation. If you are not a client and you are debating whether to hire an accountant, I encourage you to come book a free consultation with us. There's no obligation. We do offer an in-house paralegal service, so we can do your full life cycle from incorporation right through to dissolution, including the annual accounting throughout, as well as bookkeeping. And we do have some unique proprietary tools like our benchmarking analysis, our audit representation protection, and our unique industry expertise. And on that, we're actually going to a conference next week, the Access Conference, which is the major staffing industry conference, to learn about all the issues facing independent contractors. So that should be a fun and interesting thing. If you do have more questions, again, we are here to help. If you've got questions, please feel free to post them in the Q&A now, or reach out and connect with your account manager. Or if you're not a client, as I said, feel free to book a free no obligation consultation on our website, cpa4it.ca, or give us a call at 1-800-465-7532. Or God forbid, send us an email. Everyone knows how much I hate email at customerservice@cpa4it.ca. Again, we're also available on the various social media channels. We're streaming live to now. I'm going to double check. It doesn't look like I had any Q&A that came up. Oh, we did, and I missed them. I am so sorry about that. Sam asks, are there common deductible expense that small business owners miss because they are not properly tracked? Yeah, I mean, there's, we see that time and time again. What I would say is a common one that we see missed are office supplies. And think of things like cleaning supplies that you might use to clean your office that get lumped in with grocery bills. And then the groceries are personal, so you don't claim them. And tip I have on people is like literally separate out your cleaning supplies or your stationery and stuff like that from your grocery bills that you might be picking up at the same place, so that it's really clear that those are so that you don't miss those deductions that are legitimately deductible. What types of corporate tax errors are most likely to trigger a CRA review? I could do an entire webinar on that. And in fact, I did 2 weeks ago. So what I would say is go back and check our YouTube. We literally did a webinar 2 weeks to today on things that can potentially trigger a CRA audit. Because I could literally spend another half an hour just talking about that. But I would encourage you to go back out and check out our webinar on that. And I think that will answer your question there. So sorry I missed those earlier. For some reason they weren't flagging for me. I will do a better job of keeping track of that going forward. If there's any other questions, again, I'll give you a few more minutes to post those into the Q&A. Otherwise, we'll wrap up here, and I will Again, thank everyone for taking time out of your busy schedule to join us on today's webinar, and encourage you to go to our website, cpa4it.ca/events, to see what we've got coming up for our next webinars. I know we've got one and one we're doing with IT360 outside our normal sequence next week. And here's the link for the webinar. Oh, thank you very much. Let me post this. So my colleague Iman posted that. So I am going to type an answer here so that you have it. And I'm also even going to post it into the general chat. If I can find it. Oh no. There we are. Here we are. So for any of you who are looking for the YouTube link for our I just post that to hosts and panelists. If you are looking for our webinar on CRA audit triggers and how to prepare for an audit, then I just put the link in the chat for you as well. So again, thank you everyone for joining us. I'll give it one more minute and make sure we've got everything. Open. Okay, yeah, we've got to everything. Thank you again, Iman, for that. And wishing everyone a happy Tuesday, and we'll see you in 2 weeks. Bye for now.